Hey there, knowledge seekers. Welcome to the Deep Dive, your ultimate shortcut to being well-informed without the endless scrolling. We cut through the noise and get straight to the insights you need. Today, we're embarking on a deep dive into a topic that directly impacts nearly every working professional and business owner: business expenses. We're talking about everything from your daily travel and those important client meals to thoughtful business gifts and even, the mileage on your car. But more than just listing what qualifies, we're unlocking how truly understanding these rules can be a real game changer for your tax return and, importantly, your financial well-being.
That's exactly right. So many people inadvertently leave valuable money on the table. It's not because they don't have legitimate expenses, really, but because they simply don't know the precise rules for what's deductible, the limits involved, and crucially, the meticulous record keeping that makes it all possible. Our mission today is to unpack these intricacies, turn maybe some confusion into clarity, and reveal the surprising facts that can lead to significant tax savings.
Yeah, those aha moments. So if you've ever found yourself wondering if that important business lunch or maybe that long drive for work is a valid write-off, then get ready. We're going to walk through this step by step, item by item, focusing on how you can optimize these claims for maximum tax advantage and, crucially, how you report them when it comes time to file. Okay, let's kick things off with a fundamental concept. It acts as the bedrock for all business travel deductions: your tax home.
Right.
Now, this isn't necessarily where your comfy couch is, right? Where you unwind after a long day.
Not at all. That's a really common misconception, actually. Your tax home is generally your regular or main place of business, or, your post of duty. It doesn't matter where you maintain your family home. Think of it as the entire city or general area where your principal work is located. And this is an absolutely pivotal starting point for any travel expense deduction. Why? Because you can only deduct expenses incurred while traveling away from your tax home. If you're considered at home for tax purposes, those expenses are personal, not business write-offs.
Okay, that's clear. But what if you're one of those busy professionals? Maybe you have multiple regular places of business. Is it just any one of them?
No, it's specifically your main place of business, if you have more than one regular spot.
And how does the IRS figure out what's main?
Well, they look at three key factors. First, the total amount of time you spend working there. Second, the overall level of your business activity at that specific location, how much business you're actually conducting. And third, whether the income you earn from that location is significant compared to your income from other locations.
Okay.
Let's consider a practical illustration. Imagine someone who works for, say, 8 months of the year in Cincinnati. They earn $40,000 from that job. Then, for the other 4 months, they take a seasonal position down in Miami, bringing in maybe $15,000.
Okay, I can picture that. Maybe they prefer Miami.
Exactly. Even if they absolutely love the Miami weather, and maybe they even hope to live there full-time eventually. From the IRS's perspective, Cincinnati is their main place of work for tax purposes.
Because of the time and the income.
Precisely. More time spent there, and the income generated from Cincinnati is substantially higher. So this means any travel to Cincinnati would typically not be deductible if Cincinnati is their established tax home. Those are personal living costs while at their tax home. It's a really crucial distinction.
That makes sense. But what about, the true road warriors? People constantly on the move, maybe without a fixed office or a clear main place of business. How does that work?
This is where it gets really interesting, and honestly, it's a common trap for mobile professionals. If you don't have a regular or main place of business, your tax home might still be where you regularly live. That's possible. However, and this is the key part, if you genuinely have no place where you regularly live and no regular business location at all, then the IRS considers you an itinerant, basically a transient worker.
An itinerant. Okay, what's the catch?
The significant consequence, the big catch, is that as an itinerant, you cannot claim a travel expense deduction ever.
Wow. Why not?
Because you are never considered to be traveling away from home. You're essentially always at home, wherever you happen to be working at that moment. You lack that anchor point.
Okay, can you give an example of an itinerant?
Sure. Let's paint a clearer picture. Think of an outside salesperson. Their territory spans several states. Maybe their employer's main office is in Newark, New Jersey, but this salesperson never actually conducts any business in Newark. Their work assignments are temporary, maybe a few days or weeks in various cities, and they have no idea where they'll be sent next month.
Right. Very unpredictable.
Exactly. Now, maybe they occasionally stay at their sister's house in Dayton, Ohio for a weekend once or twice a year just to visit family, but they don't do any work there. They don't pay rent or contribute to expenses. In this scenario, they don't meet the criteria for a tax home in Newark or Dayton or anywhere else, really.
Because they're an itinerant.
Correct. Which means no deductible travel expenses, no meals, no lodging, because they lack that crucial home base to travel from.
Okay, so how do you avoid being an itinerant if you don't have a main office? Is there a test?
Yes. The IRS provides a set of 3 factors to help determine if you have a tax home, especially if you're trying to establish your regular living place as your tax home when you lack that main business location. You need to satisfy all 3 factors to definitively establish your home residence as your tax home. Satisfying just 2 might work depending on all the facts and circumstances, but 3 is the safe harbor.
What are the 3 factors?
Okay. Factor 1. You perform part of your business in the area of your main home and use that home for lodging while doing business there. This links work to your residence. Factor 2. You have living expenses at your main home that you duplicate because your business requires you to be away. Think paying rent or a mortgage on a place you're often traveling away from for work. And Factor 3. You haven't abandoned the area of your historical home, you have family living there, or you often use it for lodging yourself. It shows an ongoing connection.
Okay. Can we walk through an example for that?
Absolutely. Let's use an illustration. Consider an executive, lived and worked in Boston for years, has an apartment there, standard setup. Then her employer enrolls her in a demanding 12-month executive training program. Requires continuous travel all over the U.S.
So she's never in Boston for work during that year.
Right. She doesn't expect to return to the Boston office after the training and perform 0 work in Boston during the program. But, and this is key, she keeps her Boston apartment. She returns frequently on weekends, uses it for personal business, keeps her community ties there.
Okay, so she still has roots there.
Exactly. Let's say after the training, she's transferred permanently to Los Angeles. Looking back at that training year, she might not have satisfied Factor 1, no work performed in Boston during training, but she did satisfy Factor 2, duplicate living expenses, keeping that Boston apartment while traveling. And she did satisfy Factor 3, didn't abandon her home, kept contacts, returned often.
So 2 out of 3 factors met.
Right. Therefore, even without working in Boston during the training, she likely still had a tax home there based on those connections and duplicated expenses.
And that means major deductions.
Potentially, yes. It could unlock significant deductions for her travel expenses during that whole training period. It's all about demonstrating that ongoing connection to a specific place.
That's a really powerful distinction. Now, you mentioned that crucial away from home part. It's not just about crossing a city limit. You said something about needing sleep or rest.
Exactly. That's critical. To genuinely be traveling away from home in the eyes of the IRS, your duties must require you to be away from the general area of your tax home for a period substantially longer than an ordinary day's work.
Okay, longer than a normal workday.
Yes, and crucially, during that time away, you need to sleep or rest to meet the demands of your work.
So grabbing a quick nap in the car doesn't cut it.
Definitely not. Just napping in your car during a brief break simply doesn't count. The core idea is that you're released from duty long enough to get necessary sleep or rest. Not just any rest, but rest needed to continue working safely and effectively.
Okay, an example might help here.
Sure. Consider a real-world scenario, a railroad conductor. They work a 16-hour round-trip run between 2 cities. At the turnaround point, miles away from their tax home, they have 6 hours off duty. During this 6-hour break, they grab a couple of meals and rent a cheap motel room nearby to get the necessary sleep before their return trip.
Okay, 6 hours is enough for some real sleep.
Right. Because their break is long enough for substantial sleep and rest needed for their job, they are considered to be traveling away from home during that layover.
So those expenses are deductible.
Their qualifying lodging costs the motel room, and their meal expenses during that 6-hour layover would be deductible, subject to the meal limits we'll discuss. This is a common situation for many transportation pros.
Got it. Any other key points about the tax home before we move on?
Yes. One final, yet often overlooked point. It can cause a lot of confusion and lost deductions. If your tax home is different from your family home, let's take a truck driver whose family lives in Tucson, Arizona, but their employer's terminal, which functions as their tax home, their main post of duty is in Phoenix.
Okay, so they commute between Tucson and Phoenix, maybe.
If they do, they cannot deduct the cost of traveling between their Tucson family home and their Phoenix tax home. That's considered personal commuting. Nor can they deduct meals and lodging expenses while they are at their tax home in Phoenix, even if their family isn't there.
Because Phoenix is their tax home.
Exactly. Those expenses are personal commuting and living costs. It's a common misunderstanding that, unfortunately, prevents many potential deductions.
Okay, now that we've firmly nailed down what it means to be traveling away from home, let's get into the exciting part. What specific expenses can you actually write off? This is where the rubber meets the road for tax savings.
Right. Once you've clearly established you're genuinely traveling away from your tax home for business purposes, you can then deduct your ordinary and necessary expenses.
Ordinary and necessary. We hear that phrase a lot in taxes. Can you break it down?
Sure, an ordinary expense is one that's common and accepted in your particular trade or business. Think a graphic designer deducting design software costs, that's ordinary, or a farmer deducting combine repair, also ordinary for their business.
Okay, typical for the industry.
Exactly. A necessary expense, on the other hand, is one that is helpful and appropriate for your business. It doesn't have to be strictly required, like indispensable, just helpful.
Helpful and appropriate.
Right. Helpful for running your business efficiently or maybe increasing your income. Think of it like this. Ordinary means it's typical for your line of work. Necessary means it helps you do your job better, even if it's not strictly mandatory. Like, say, investing in a new tool that genuinely boosts your efficiency.
Got it. That makes perfect sense. So give us the comprehensive rundown. What qualifies? Lay out the roadmap for maximizing these deductions.
Okay, the list is quite comprehensive, and understanding each category is absolutely key to maximizing your legitimate deductions. Let's break it down. First up, transportation costs. This is the big one for many. It includes your airfare, train tickets, bus fares, or the cost of using your own car to travel between your tax home and your business destination.
So the main travel ticket.
Yes, but it's more detailed than that. It also covers the cost of taxis, commuter buses, or maybe airport limousine fares you use to get between the airport or station and your hotel. And crucially, between your hotel and your actual work location, client sites, or meeting places while you're at the destination.
Ah, so those smaller cab fares add up and count too.
They definitely do. Of course, keep in mind, if you happen to travel for free, maybe using frequent flyer miles you didn't pay for, your cost is zero, so no deduction there. But any out-of-pocket transportation costs are covered. Next, consider baggage and shipping. If you incur costs for sending baggage or maybe sample and display materials between your regular tax home and your temporary work location, those costs are fully deductible.
Good for salespeople or artists, maybe.
Exactly. Anyone who needs to transport goods or materials for their business while traveling. Then, a really big one for many, car expenses. This category covers operating and maintaining your car specifically while you are away from home on business. Now, you have a critical choice here, which we'll dive into much deeper shortly. You can either deduct your actual expenses, things like gas, oil, repairs, insurance for the business portion,
The simpler way.
or use the simpler standard mileage rate. Regardless of which method you choose, always remember this tax-saving tip. Deduct business-related tolls and parking fees separately.
Oh, those are always separate.
Yes, they're always deductible in addition to your chosen car expense method, actual or standard mileage.
Oh.
Now, if you rent a car while away for business, you can only deduct the portion directly attributable to business use. So if you rent for 10 days but only use it for business on 5 days, you can only deduct 50% of that rental cost. You need to track that usage.
Okay, what else?
Crucially, we have lodging and meals. Your lodging expenses, the cost of your hotel, motel, or other temporary housing, are fully deductible when traveling away from home overnight for business, as are your non-entertainment-related meals. However, these meals are only deductible if your business trip is overnight or long enough that you genuinely need to stop for sleep or rest to properly perform your duties.
And meals includes.
Meals include the cost of food, beverages, any associated taxes, and, importantly, tips. We'll be diving into the nuances of the 50% limit on meals very soon, as that's a huge area of confusion and potential savings.
Right, the 50% rule. Okay, anything else?
Finally, we have incidentals. This seemingly small category can capture a surprising variety of costs that really add up. This includes expenses like dry cleaning and laundry while on your trip, business calls, whether made by phone, fax, or other communication devices, and any tips you pay for any of the deductible expenses we've listed above.
So tips for the hotel maid or the bellhop.
Yes, those can count. Other similar ordinary and necessary expenses directly related to your business travel, like maybe public stenographer fees or the cost of renting a computer or temporary office space while on the road, also fall into this category.
What's the rule of thumb here?
If it's genuinely necessary to enable your business activities while traveling, and it's ordinary for your type of work, it's likely deductible as an incidental or other travel expense. Now, here's a critical detail. Often missed, and it can save you from a disallowed deduction, particularly when traveling with others. If a spouse, a dependent, or any other individual accompanies you or your employee on a business trip, their travel expenses are generally not deductible.
Okay, that seems straightforward, unless...
Unless you can prove a bona fide business purpose for their presence. And here's the kicker. Incidental services, like, say, typing notes during a meeting or just helping entertain customers, are typically not considered a sufficient bona fide business purpose by the IRS.
So it has to be a real business need for them to be there.
Exactly. The IRS requires a substantial direct business reason for their presence. It's a high bar to clear. Furthermore, watch out for bundled expenses. If you have single expenses that mix costs for meals, entertainment, and other services like lodging, maybe a hotel bill includes a room charge plus a meal package, you must find a reasonable basis to separate out the meal cost.
Why separate them?
Because different rules and limits apply, like the 50% meal limit we keep mentioning or the 0% entertainment limit we'll get to, versus the usually 100% deductible lodging. Clarity and itemization on your receipts are absolutely paramount here.
Okay, meals on the road. You mentioned it's a huge area for questions, probably a lot of confusion too. Let's tackle it head on. What exactly is the deal with this 50% limit? I feel like I hear conflicting things constantly.
You're right, it is a constant source of questions. So for most business meals, whether you're eating alone while traveling away from home for business or dining with clients or colleagues for a specific business purpose, you can generally only deduct 50% of the unreimbursed costs.
50%. Okay.
This applies across the board. Doesn't matter if you're an employee or self-employed. This 50% limitation kicks in after you've determined the meal itself is ordinary, necessary, and critically not lavish or extravagant under the circumstances.
Lavish or extravagant? That sounds subjective.
It is based on facts and circumstances. For instance, if you spent $200 on a business meal, but maybe $110 of that was clearly excessive or extravagant in that specific context, like ordering multiple bottles of very expensive wine, when water would do the remaining $90 would then be subject to the 50% limit.
So your deduction would only be $45 in that case.
Exactly. It's basically the IRS's way of acknowledging there's usually a personal element, a personal benefit to eating a meal, even if it's for business.
That makes sense. But how do we even figure out the cost? Does this mean keeping every single coffee receipt, every sandwich receipt? Sounds like a potential record-keeping nightmare.
Not necessarily a nightmare, but diligence is definitely key. You actually have two distinct ways to figure your meal expenses, which offer some flexibility. That's a tax-saving tip right there. Choose the method that works best for you. First, there's the actual cost method. This means, yes, meticulously keeping detailed records of every single food item, beverage, associated tax, and tip expense. High level of organization needed.
Okay, the detailed route.
Right. And remember that lavish or extravagant rule. Even using actual cost, the meal can't be deemed excessive. The IRS is clear, though, a meal isn't automatically disallowed just because it's at a high-end restaurant if it's considered reasonable for that specific business context.
Yeah.
You know, closing a major deal might warrant a nicer place than a routine lunch.
Okay, what's the alternative to tracking every single penny?
The second method, often much simpler, is the standard meal allowance. This is a simplified approach where you use the federal M&IE rate that stands for meals and incidental expenses.
The M&IE rate, got it.
This rate covers your meals and some minor incidentals, like tips for baggage handlers, but not your lodging costs. Those are always separate. These M&IE rates are updated annually, usually October 1st, and they vary by location because, you know, it costs more to eat in New York City than in a small town.
Makes sense. Where do you find these rates?
For travel within the continental U.S., the rates are set by the General Services Administration, the GSA. You can easily look them up online. For example, for travel through September 30, 2024, the rate for most small localities was $59 per day. It then increased to $68 per day starting October 1st, 2024.
And bigger cities are higher.
Yes, major cities and other high-cost areas have higher rates. Knowing where to find the most current federal M&IE rates is key. The website is gsa.gov. Just search for per diem rates. gsa.gov travel plan book per diem rates. It's a powerful tool for simplifying record keeping and ensuring you deduct the maximum allowable without tracking every single receipt.
That sounds much easier. What about travel days, like the day you leave or come back, you're not gone the whole day?
Great question and a crucial point for accuracy. You must prorate the full day M&IE rate for partial travel days. A common and IRS-accepted method is to claim 34 or 75% of the standard meal allowance for your departure day and another 34 for your return day.
75% for the first and last day.
Exactly. It ensures you're fairly accounting for the partial travel. So if the standard rate was $68, you'd claim $51 for your travel day. $68 times 0.75. It's a simple calculation, but often overlooked.
Any other surprising details here? What about those really small costs that aren't quite meals, like maybe just a bottle of water or a newspaper at the airport? Are they just lost?
Here's a fascinating detail and definitely a potential tax-saving nugget for certain situations. There's an optional incidental expenses only method. If you choose this, you can deduct a flat $5 per day just for incidental.
$5 a day.
Yes, but here's the catch. Only if you didn't pay or incur any meal expenses on that specific day. Maybe you had meals provided for free at a conference, for example.
Okay, and the best part?
The best part is this $5 deduction is not subject to the 50% limit. It's 100% deductible. It's a small amount, sure, but it can add up over many travel days. Just keep in mind, remember, there's no optional standard lodging amount. Your deduction for lodging is always your actual cost, so keep those hotel receipts meticulously.
Okay, so the 50% limit applies broadly to most meals, but you hinted there are exceptions. When can I bypass that 50% limit entirely and get a 100% deduction, or maybe more than 50%? That's a true tax-saving nugget. This is what listeners are really looking for.
Absolutely. Understanding these exceptions is key to strategic tax planning and can significantly boost your deductions. There are several important scenarios where the 50% limit on meals does not apply, allowing for a 100% deduction, or in one case, 80%.
Okay, lay them out for us.
Exception 1. Expenses treated as compensation. If your employer explicitly treats a meal expense as compensation to an employee, meaning they report it as wages on the W-2, subject to withholding, then it's 100% deductible by the employer. This isn't super common for typical meals, but it exists. Exception 2. Employees reimbursed expenses under an accountable plan. This is huge for employees. If you are an employee and your employer reimburses you for meal expenses under a qualified accountable plan, then you, the employee, are not subject to the 50% limit on your side.
So the reimbursement isn't taxed?
Correct. The reimbursement is non-taxable income to you. Now, the employer is still subject to the 50% limit when they deduct that reimbursed expense, assuming it was a standard business meal. But for you, the employee, it's a clean reimbursement. We'll definitely dive deeper into accountable plans later. They're critical.
Okay, good. What else?
Exception 3. Recreational expenses for employees. Think company holiday parties, summer picnics, team-building outings, primarily for the benefit of your rank-and-file employees. The food and beverage costs for these events are 100% deductible.
Why the difference?
Because the IRS sees the benefit here as general employee morale and welfare, not a specific business discussion tied to a meal. Exception 4. Items available to the public. If you provide meals, snacks, or samples to the general public, maybe as advertising or promotion, those costs are 100% deductible. Think free food samples at a trade show or sponsoring a community event with free food. Exception 5. Meals sold to customers. If you're in the business of selling meals like a restaurant, caterer, or even a convenience store selling prepared food, the cost of the food you furnish to customers is, naturally, 100% deductible as cost of goods sold, not subject to the 50% limit.
Makes sense. You mentioned an 80% deduction.
Yes, exception 6. This is a fantastic and often overlooked exception for specific professionals subject to hours of service limits set by the Department of Transportation. This includes people like certain air transportation workers, pilots, crew, dispatchers, interstate truck and bus drivers, railroad employees, and certain merchant mariners.
Okay, people with really demanding schedules.
Exactly. Because of the demanding nature of their work and the federal regulations on their rest periods, these individuals can deduct 80% of their meal expenses incurred while traveling away from home on business instead of just 50%.
80%, that's a significant difference.
It really is. This higher deduction applies specifically when those meals occur during or incident to periods subject to these DOT hours of service limits. It's a clear tax advantage built in for these specific regulated professions.
That's a really thorough breakdown of meal deductions. Now, let's broaden the scope. Does crossing international borders change how travel expenses are treated? Is a business trip to, say, Canada handled differently than one to France? Does it get more complex?
It absolutely does. And this is where the rules become much more nuanced, sometimes quite complex. Understanding these distinctions is paramount to avoiding disallowed deductions, especially for pricey international trips.
Okay, let's start simple. What about travel just within the U.S.?
For travel within the United States, which for tax purposes means the 50 states and the District of Columbia, the rule of thumb is fairly straightforward. If your trip was primarily for business, you can generally deduct all your travel expenses related to getting to and from your business destination. Airfare, car costs, etc. And of course, all your business-related expenses incurred while you're there, lodging, meals, subject to limits, incidentals.
Primarily for business. What if there's some personal time mixed in?
Good question. If you decide to extend your stay for personal vacation or maybe take a little side trip for personal reasons, you can only deduct the business-related portion of your travel costs.
Can you give an example?
Sure. Let's say you work in Atlanta. You fly to New Orleans for a 3-day business conference. That's clearly business. But on your way home, you decide to fly via Mobile, Alabama, and spend 3 extra days visiting your parents there before flying back to Atlanta.
Okay, mixing business and personal.
Right. In this case, you can deduct the full round-trip cost of getting to and from New Orleans, your business destination, and all your business expenses while in New Orleans, lodging, 50% of meals, conference fees, etc. However, the extra cost of flying to Mobile and any expenses incurred during those personal days visiting family in Mobile meals, lodging there, would not be deductible. You have to carve out the personal portion.
That seems logical. Now, what about travel outside the United States? You said it gets more specific.
It does. The rules tighten up considerably, so close attention is needed here for potential tax savings, especially on longer trips. First, the easy case. If your trip outside the U.S. is entirely for business, then yes, all your ordinary and necessary travel expenses of getting there and back, and your expenses while there for business are fully deductible. Simple.
Entirely business.
Yeah.
Okay, but what if it's mostly business but not entirely?
Here's a very significant tax planning point, a real gem for international travel. Your trip is considered entirely for business, even if it wasn't 100% business, provided you meet certain exceptions. One major exception. If you spent less than 25% of the total time you were outside the U.S. on non-business activities.
Less than 25% personal time makes the whole trip count as business.
For the travel costs getting there and back, yes. For this calculation, you count both the day your trip began, left the U.S., and the day it ended, returned to the U.S., as days outside the U.S.
Okay, let's walk through that example.
Let's say you fly from Seattle to Tokyo. You spend 14 days in Japan on specific business meetings and activities. Then you take 5 days for personal sightseeing, plus count 2 travel days, 1 each way.
So 14 business plus 5 personal plus 2 travel equals 21 total days outside the U.S.
Exactly. Now calculate the personal percentage. 5 personal days divided by 21 total days. That's about 23.8%.
Which is less than 25%.
Right. So because your personal time was less than 25% of the total time outside the U.S., your entire trip is considered business-related for the purpose of deducting travel costs. This means you can deduct the full round-trip plane fare from Seattle to Tokyo, and you can deduct your business expenses for the days you actually worked, the 14 business days, plus the 2 travel days, so 16 days of related expenses like lodging, 50% of meals, etc.
Wow, that's a huge benefit. Deducting the whole airfare, even with personal days.
It's a powerful exception that can save a substantial amount on long international trips. Definitely worth planning for, if possible.
Okay, but what if you don't meet that exception? What if your personal time is 25% or more?
If you don't meet one of these entirely business exceptions, there are others, like if you didn't have substantial control over arranging the trip, or if a vacation wasn't a major consideration, and your trip was still primarily for business, then you must allocate your travel expenses between business and personal days. You can't deduct the full cost of getting there and back.
Allocate? How does that work?
You calculate the deductible amount of your round-trip travel costs, like airfare, by multiplying the total cost by a fraction. The fraction is number of business days outside the U.S. divided by total number of business and non-business days outside the U.S.
Okay, so you only deduct the percentage that reflects your business time.
Precisely. This allocation ensures you're only deducting the legitimate business portion of the transportation costs. Your expenses, while at the destination, lodging, meals, are still deducted based on whether they occurred on a business day or a personal day.
So it's really important to know what counts as a business day for this allocation.
Absolutely critical. Business days include Transportation days, assuming you traveled by a reasonably direct route without major personal detours. Days where your presence was required for a specific business purpose, even if you spent part of the day on personal activities. Days you actually spent on your principal business activities. And crucially, certain weekends or holidays that fall between other business days.
Weekends can count as business days.
Yes, if they fall between scheduled business activities. For example, you're in Quebec for a required business meeting on Friday and another required meeting on the following Monday. In that case, Saturday and Sunday are counted as business days for allocation purposes, even if you spend them sightseeing, because they're sandwiched between work days, making it impractical to return home.
But if business ended Friday?
Right. If business ended Friday and you stayed until Monday solely for personal reasons, then Saturday and Sunday would be non-business days. Understanding this detailed allocation can make a really big difference in your final deduction amount.
That's definitely intricate for international trips. Now, what about those fancy trips like luxury cruises? Can people actually write those off, or is that mostly a myth?
You can deduct business travel by ship, but with very specific and significant limits, so absolutely do not expect a free vacation loophole. For luxury water travel, which generally means any travel by ocean liner, cruise ship, or other form of luxury water transportation, there's a daily deduction limit. This limit is based on the highest federal per diem rate allowed for U.S. government employees for travel inside the U.S. at the time of your travel, multiplied by 2.
Okay, a specific daily cap. Do you have an example number?
It changes, but let's use a hypothetical. Say for May 2024, that highest federal per diem was $398. The daily limit for luxury water travel would be twice that, so $796 per day. Now, if your 6-day business cruise costs a total of $6,200, your maximum deduction couldn't exceed $4,776. That's 6 days multiplied by the hypothetical $796 daily limit, even if you spent more.
Okay, capped at the daily limit. Is there anything else?
Yes. Here's a crucial detail that many taxpayers miss, and it can further reduce your deduction. If your luxury water travel expense includes separately stated amounts for meals or entertainment on the invoice, those specific amounts are subject to their own limits. 50% for non-entertainment meals and 0% for entertainment before you even apply the daily luxury water travel limit.
Whoa, okay, so limits on top of limits. Example.
Let's take that $6,200 cruise again. Suppose the invoice clearly broke it down. $3,700 for meals, $1,000 for entertainment, like show tickets maybe, and the remaining $1,500 for the actual cabin fare and transportation. First, the entertainment portion, $1,000, is entirely non-deductible, 0. Second, the meals, $3,700, are subject to the 50% limit, making them $1,850 deductible. Third, the other travel, $1,500, is potentially deductible. So your total allowable cost before considering the daily limit is on $1,850 meals, plus $1,500 other travel, $3,350.
So even though the daily limit was $4,776, the actual deduction is only $3,350.
In this case, yes. Your deduction would be limited to the $3,350 calculated after applying the meal and entertainment rules, because that's lower than the overall daily luxury water travel limit. Now, the important flip side: if meals or entertainment charges are not separately stated or clearly identifiable on the bill, you generally don't have to allocate any portion of the total charge to them before applying the daily limit. So clarity on the invoice is absolutely key here.
Got it. And what about attending conferences or conventions? Are those generally straightforward, or do they have unique rules too?
They definitely have their own specific hurdles, especially regarding the location. You can deduct travel expenses for attending a convention, but only if you can clearly show that your attendance benefits your trade or business.
Benefits your business. How do you show that?
Simply being appointed or elected as a delegate isn't enough. The convention's agenda and your specific participation must be directly connected to your business or professional duties. You need to demonstrate how the sessions, the workshops, the networking opportunities directly contribute to your professional growth or business operations. The connection must be clear.
Okay. Does the location matter? Like U.S. versus overseas?
Yes, location matters a lot, especially for conventions held outside the North American area. The rules become even stricter.
Outside North America, what counts as North America here?
The North American area is actually quite broad for tax purposes. It includes the U.S., its possessions like Puerto Rico, U.S. Virgin Islands, Canada, Mexico, and numerous Caribbean countries and territories covered under specific agreements like Jamaica, Barbados, Bermuda, etc. Check IRS Publication 463 for the full list.
Okay, so if it's outside that broad area, stricter rules apply.
Yes. The meeting must not only be directly related to the active conduct of your trade or business, but it must also be as reasonable to hold the meeting outside that area as within it.
As reasonable. How do you prove that?
The IRS looks at a reasonableness test. They consider factors like the purpose of the meeting, the activities of the sponsoring organization, is it truly an international body, the locations of its members' homes, and maybe the locations of past meetings. Essentially, you need a solid justification for why an overseas convention was the most logical and practical choice for your specific business needs, not just a chance for a trip.
Right. What about conventions on cruise ships? I hear about those.
Cruise ship conventions. Very specific, very strict rules here. There's a hard $2,000 annual deduction limit per taxpayer for attending conventions or seminars on cruise ships.
Only $2,000 a year total.
Yes, a maximum $2,000 per year. And that's not all. The cruise ship must be a vessel registered in the United States, and all ports of call on that cruise itinerary must be located within the U.S. or its possessions.
U.S. ship, U.S. ports, $2,000 limit. Anything else?
Yes, the documentation requirements are intense. This is where many taxpayers fall short. You need to attach 2 very detailed written statements to your tax return. One statement must be signed by you. It needs to detail the total days of the trip, excluding travel from the port, the number of hours each day you devoted to scheduled business activities, and a program or agenda of those activities. The second statement must be signed by an officer of the sponsoring organization. It must include a schedule of the business activities for each day of the convention and the number of hours you attended those scheduled activities, verified by the sponsor.
Wow, that's incredibly detailed. So no fudging the numbers.
Absolutely not. Without these specific, meticulous signed statements attached to your return, your deduction will be disallowed, even if you meet all the other criteria. U.S. ship, U.S. ports, $2K limit. It's a very high bar to clear, designed to prevent disguised vacations. Don't overlook that paperwork requirement.
Okay, let's shift gears now to something closely related. Client entertainment and business meals, not necessarily during travel. I know the rules here changed significantly a few years back, generally making things tougher for deductions. So what does this all mean now for, say, a team outing or that crucial client dinner? How do we navigate this landscape?
You're absolutely right. The rules around entertainment changed profoundly with the Tax Cuts and Jobs Act of 2017. This is a major area where deductions were significantly curtailed, and frankly, many taxpayers and even some advisors are still catching up or are unclear on the nuances. Generally speaking, the big headline is, you can no longer deduct any expense related to activities considered entertainment, amusement, or recreation.
Zero deduction for entertainment.
Correct. A flat zero deduction for the entertainment activity itself. This means no deductions for things like buying tickets to sporting events, concerts, theater shows, or taking clients golfing or to nightclubs or on hunting or fishing trips. The cost of the entertainment activity is simply non-deductible.
How broad is the definition of entertainment?
It's very broad. The IRS defines entertainment as almost any activity generally considered to provide amusement or recreation. Examples include hosting guests at nightclubs, social clubs, athletic clubs, sporting clubs, taking them to theaters, sporting events, using facilities like yachts, hunting lodges, fishing camps, swimming pools, tennis courts. It even extends to covering personal, living, or family needs of individuals, like providing a hotel suite or a car to customers or their families for personal use outside a direct business context. The IRS views these purely as non-deductible personal benefits, even if there's a tangential business connection or goodwill intended.
Okay, so the entertainment activity itself is out, no deduction. But what about business meals that happen at or during an entertainment event? Say, I'm at a baseball game with a client, the tickets are non-deductible, we established that. But what if we buy hot dogs and drinks at the stadium while discussing business? Is that food also non-deductible because it happened at the game? That feels like a gray area.
This is where it gets fascinating, and it's a critical distinction for potential tax savings, albeit limited. There's a specific carve-out for food and beverages. If food or beverages are provided during or at an entertainment event, you might still be able to deduct the cost of those meals, subject to the 50% limit, if certain conditions are met.
Okay, what are the conditions?
The key condition is that the cost of the food and beverages was purchased separately from the entertainment, or the cost was stated separately from the entertainment cost on the bill, invoice, or receipt.
Purchased separately or stated separately. Got it. Example.
Let's use your baseball game example. You take a client. The cost of the game tickets themselves, non-deductible entertainment. However, while you're at the game, discussing business specifics, you go to the concession stand and buy hot dogs, sodas, and maybe some popcorn. You pay for these separately from the tickets.
Okay, separate transaction at the concession stand.
Right. In this case, you can deduct 50% of the cost of those separately purchased hot dogs and drinks, assuming the meal wasn't lavish, and you meet the other business meal requirements, like having a business discussion. The key is that separate purchase and clear itemization or receipt.
Okay, now contrast that. What if it's not separate?
Let's contrast that with this scenario. Imagine you purchase a corporate suite at a basketball game to host clients. The invoice for the suite likely includes access to the game, entertainment, and might also cover food and beverages provided within the suite. If that invoice shows one lump sum for the suite, or includes the cost of food and beverages, but does not state the food beverage cost separately from the entertainment cost, the suite access,
Right.
then none of it is deductible. It's all treated as one non-deductible entertainment expense because the food wasn't itemized separately.
But what if the suite invoice does break it out?
Now that's the crucial difference. If that same suite invoice does separately state the cost of the food and beverages as a distinct line item from the suite rental game access, then you can deduct 50% of that separately stated food and beverage cost. The suite rental itself remains non-deductible entertainment.
So the absolute key, the real aha moment here for tax savings, is getting that clear, separate itemization of food and beverages from the entertainment portion on the bill.
Absolutely vital. Without it, you get zero deduction for the food in an entertainment setting. With it, you can potentially get 50% back on the food and drink portion. Always ask for that itemized receipt. And remember, even if you can deduct the meal portion, any allowed meal expense must still meet the basic tests. It must be ordinary and necessary and not lavish or extravagant under the circumstances. These general rules always apply.
Right. And do the exceptions to the 50% limit apply here too?
Yes, absolutely. The exceptions we discussed earlier, like meals for employee recreational events, holiday parties, meals treated as compensation, meals sold to the public, or for those subject to DOT hours of service still apply and could allow a 100% or 80% deduction, even if they technically occurred alongside entertainment, provided the costs were separate. Always look for those specific exceptions.
Okay, let's shift from meals and entertainment to another common business practice, giving gifts, gestures of goodwill, client appreciation, that sort of thing. Are there any surprising or often missed limits here that listeners really need to be aware of? Seems simpler than meals, but maybe not.
Oh, absolutely. There are limits, and they are surprisingly strict. The business gift deduction is one of the areas where taxpayers often overestimate what they can actually claim. It's not as simple as just deducting whatever you spend. The hard rule is you can deduct no more than $25 for business gifts you give directly or indirectly to each person during your entire tax year.
$25 per person per year. That seems quite low in today's world.
It is quite low. It's a limit that hasn't been updated in decades, actually. But yes, $25 per recipient per year is the hard limit for your deduction. There's virtually no flexibility on that amount, so you need to be very mindful if you plan on giving gifts, especially multiple gifts to the same individual or organization throughout the year.
Okay, $25 per person. So if I send a nice gift basket, maybe costing $100 to a company, just as a thank you for their business, how does that $25 limit apply? Does it count as one $25 gift to the company, or is it more complicated?
That's an excellent question, and it highlights the indirectly part of the rule. A gift given to a company but intended for the eventual personal use or benefit of a particular person or a limited group of people within that company is considered an indirect gift to those individuals.
Okay, so it matters who ultimately gets it.
Precisely. Let's use your example. Say you and your spouse send 3 beautiful $80 gourmet gift baskets to a local client company to thank them for a big project. Your total cost is $240. Now, suppose 3 of the company's executives end up taking those gift baskets home for their family's personal use over the holidays.
Right, that seems likely.
In that situation, your deduction is limited to $25 per executive. Since 3 executives ultimately receive the benefit, your total deduction isn't the $240 you spent, but only $75. $25 multiplied by 3 executives.
Wow, only $75 deduct on a $240 spend. That's a huge difference.
It is. The key is identifying the ultimate individual recipients who personally benefit from the gift. If it's widely distributed to, say, all 50 employees in a break room, the rules might be different. But if it clearly benefits specific individuals, the $25 limit applies to each one. Also, an important aggregation rule for married taxpayers. If you and your spouse both give gifts, perhaps even to the same person, you are treated as one taxpayer for applying this $25 limit.
So a couple can't give a $25 gift each to the same person and deduct $50.
Correct. The limit is $25 per recipient from the couple combined. It doesn't matter if you have separate businesses or jobs. The same aggregation rule applies if a partnership gives gifts, the partnership, and all its partners are treated as one taxpayer for the $25 per person limit. It's designed to prevent splitting gifts just to get around the deduction limit.
Okay, that's clear. What about the extra costs, like fancy wrapping paper or maybe engraving or shipping the gift? Are those costs included in the $25 limit, or are they separate?
That's another good question. And there's a specific rule for incidental costs. Costs like engraving on jewelry or the cost of packaging, insuring, and mailing the gift are generally not included in determining the cost of the gift for purposes of the $25 limit.
Oh, so those are deductible on top of the $25.
Usually, yes.
Yeah.
But there's a crucial caveat. This only applies if these incidental costs do not add substantial intrinsic value to the gift itself.
Substantial value. Example.
For example, standard gift wrapping is definitely incidental. The cost of the wrapping paper isn't part of the $25. But let's say you buy an expensive, ornate, maybe crystal basket to hold some fruit you're giving as a gift. If the basket's value is substantial compared to the fruit, then the cost of that fancy basket is not considered incidental. It would count toward the $25 gift limit.
So choose your packaging wisely. Don't let the wrapping cost more than the gift, basically.
Exactly. Don't let the wrap become the main event if you want to deduct its costs separately. One final point here, tying back to our earlier discussion. Remember the gift versus entertainment distinction. This is important. If an item could reasonably be considered either a gift or entertainment, like maybe tickets to a show or a sporting event that you give away to a client instead of attending with them,
Yes.
it will generally be considered entertainment by the IRS. And as we just discussed, entertainment expenses are now generally non-deductible.
So giving tickets away is usually non-deductible entertainment, not a $25 gift.
That's generally the safer assumption now. However, if it's packaged food or beverages that you intend the customer to use at a later date, like that gourmet gift basket we talked about, the IRS treats that as a gift, making it subject to that strict $25 deduction limit per person. This distinction is key when planning your client appreciation efforts. The form and intended use of the item really matter for tax purposes.
Okay, let's move on to something huge for countless professionals and small businesses. For many, the car isn't just transportation. It's a fundamental business tool. This has got to be a massive area for potential tax savings. Let's really dive into what's deductible and how, because getting this right could significantly impact your bottom line.
Absolutely. This is definitely where many individuals have a substantial opportunity for deductions, but it's also where many fall into common traps, especially around commuting. So, first things first, a crucial distinction that trips up so many people. Commuting expenses are generally not deductible.
Commuting is not deductible. Define commuting for us.
Commuting is your regular daily drive from your home to your primary workplace or your main office. That back and forth trip is considered a personal expense by the IRS, and this includes related costs. Even paying for parking fees at your regular place of business, your main office building's garage, for instance, those are considered non-deductible commuting expenses.
Even if you have advertising on your car, like company logos.
Doesn't matter. Putting advertising on your car doesn't change the fundamental personal nature of that commute. You still can't deduct expenses for those commuting miles or other purely personal uses of the car. The IRS views getting to and from your main job location as a personal responsibility, not a business expense.
Okay, crystal clear. Commuting, personal, non-deductible. So what transportation is deductible when it involves your vehicle? Where are the savings?
Right, let's focus on the deductible driving. You can deduct transportation expenses for driving between one workplace and another if you happen to work at 2 or more different places in the same day. This applies even if they're for different employers. Let's say you have a main office where you start your day. Then mid-morning, you drive across town to a client's office for a meeting. That drive from your main office to the client's office and maybe back again is deductible business mileage.
Okay, driving between work locations during the day counts. What else?
You can also generally deduct your daily transportation cost between your home and a temporary work site if that site is outside the metropolitan area where you normally live and work. This is especially beneficial if your principal place of business is your home. If you have a qualifying home office, that's your main base.
Yes.
Then you can generally deduct the full cost of round-trip transportation between your home office and a client's or customer's place of business or other temporary work locations, because your home is your primary work location in that case.
That's a big one for home-based businesses.
Huge. And one more. Business-related parking fees and tolls incurred while you are on business are deductible. So parking fees when you are visiting a customer, a client, or at a temporary work site are fully deductible. These are not considered part of your non-deductible daily commute parking.
Okay, that clarifies the deductible versus non-deductible driving. Now, for the expenses themselves, the big decision for car expenses. It usually boils down to the standard mileage rate versus claiming actual expenses. Which path should a listener consider for the best tax savings? This feels like where it gets really interesting for maximizing deductions.
It is indeed a fundamental choice, and it can significantly impact the size of your deduction. Understanding the nuances, the pros and cons of each, is absolutely key to making the right decision for your situation. First, let's talk about the standard mileage rate. This is often seen as the simpler method. You use a set rate per mile, determined annually by the IRS, to figure your deductible car expenses.
And for 2024, that rate is
For business use in 2024, the rate is 67 cents.
67 cents per mile.
Okay, 67 cents per business mile. What does that cover? That rate is designed to cover a broad range of the variable and fixed operating costs of your car. It includes estimates for depreciation, maintenance, repairs, gasoline, oil, insurance, and vehicle registration fees. It's meant to be a kind of all-inclusive amount for those general operating costs.
So the main benefit is simplicity. Just track miles.
Simplicity is a huge benefit, yes. You primarily just need to meticulously track your business miles, the date, destination, and purpose. But here's a great tax-saving nugget often missed. Using the standard mileage rate does not prevent you from deducting certain other costs separately.
Oh, what?
You can also deduct your business-related tolls and parking fees separately, in addition to the standard mileage rate deduction. Those specific costs are not factored into the per-mile rate. Same goes for any business portion of interest on your car loan or state and local personal property taxes on the vehicle. Those can be deducted separately too.
Interesting. Are there rules about when you can choose the standard mileage rate?
Yes. Very important rules here. If you own the car, you have flexibility, but there's a crucial first-year decision. You must choose to use the standard mileage rate in the first year the car is available for business use if you want the option to switch methods later.
So choose standard mileage first year if you want flexibility later.
Exactly. If you start with the standard rate, then in later years for that same car, you have the flexibility to switch between the standard mileage rate or the actual expenses method, depending on which one yields a larger deduction for that specific year. This annual flexibility for owned vehicles is a powerful tax planning tool.
What if you choose actual expenses first?
If you choose actual expenses, including special depreciation like Section 179, in the first year for a car you own, you generally cannot switch to the standard mileage rate for that car in any later year. You're locked into actual expenses.
Okay. What about leased cars?
Leased cars are different. If you lease a car and choose the standard mileage rate, you must use the standard mileage rate for the entire lease period, including renewals. You cannot switch back and forth between methods with a leased car if you start with the standard rate. That initial choice is permanent for that lease.
Got it. Are there situations where you simply cannot use the standard mileage rate at all?
Yes, there are several prohibitions. You are barred from using it if you claimed a Section 179 deduction or took the special depreciation allowance, like bonus depreciation, on the car in the year you started using it for business. You used the actual car expenses method for a car you leased after 1997, or, and this affects businesses with fleets, if you own or lease 5 or more cars that are used for business at the same time, like a taxi fleet or a delivery business using multiple cars simultaneously.
5 or more cars used at the same time. What if you just own 5 cars but only drive one at a time for business?
That's an important distinction. If you alternate using 5 or more cars for business, meaning you don't use them simultaneously, you can still use the standard mileage rate for all of them, assuming you meet the other requirements. For example, a busy salesperson who owns 3 cars and 2 vans and maybe drives one on Monday, another on Tuesday, etc., for customer calls can potentially use the standard mileage rate for all 5 because they aren't using them concurrently.
Okay, that covers the standard rate thoroughly. Now, let's unpack the actual car expenses method. What does that involve?
This approach involves meticulously tracking and deducting all your actual costs related to the portion of your car's use that was for business. This includes the obvious variable costs like gasoline, oil, repairs, tires, washing, fluids. It also includes fixed costs like insurance premiums, vehicle registration fees, licenses, and the business portion of personal property taxes if your state has them. If you finance the car, you can deduct the business use percentage of the interest paid on the car loan. If you lease, the business percentage of your lease payments is deductible here too. But arguably, the most significant component under the actual expenses method, especially for newer or more expensive cars, is depreciation.
Depreciation. That's deducting the cost of the car over time, right?
Essentially, yes. It accounts for the wear and tear and loss in value of the car as a business asset. For depreciation purposes, the IRS generally defines a car as any four-wheeled vehicle, including trucks and vans, with an unloaded gross vehicle weight of 6,000 pounds or less.
6,000 pounds. Why that weight limit?
That weight limit is important because heavier vehicles, typically larger trucks and SUVs, often qualify for different, usually more favorable, rules for depreciation and especially for the Section 179 deduction.
Ah, Section 179. You mentioned that prevents using the standard mileage rate later. Tell us more about it. Sounds like a big tax saver.
It can be a massive tax savings opportunity, particularly under the actual expenses method. The Section 179 deduction is an incredible provision in the tax code. It allows businesses to elect to deduct the full purchase price of certain qualifying depreciable assets, including qualifying vehicles, in the year they place them in service, rather than capitalizing and depreciating them over several years.
Deduct the whole cost up front.
Up to certain limits, yes. This provides a substantial immediate deduction, significantly reducing your taxable income in the year of purchase. For heavier sport utility vehicles, those over 6,000 pounds GVWR, but not more than 14,000 pounds, placed in service in 2024, the maximum Section 179 deduction you can claim is limited to $30,500.
$30,500 for qualifying SUVs. What about regular cars under 6,000 pounds?
For cars and lighter trucks vans under 6,000 pounds, the Section 179 deduction is tied into the overall annual luxury auto depreciation limits, which are much lower. For 2024, the first-year limit, including Section 179 and bonus depreciation, is $20,400 if bonus depreciation is claimed, or $12,400 if bonus is not claimed. So the benefit is much larger for those heavier vehicles.
Okay, so Section 179 is great for upfront deductions, especially on bigger vehicles. But what's the catch again?
The critical trade-off, as we mentioned, is if you claim any Section 179 deduction for a car, you cannot use the standard mileage rate for that specific car in any future year. You are permanently locked into using the actual expenses method for that vehicle for its entire business life. It's a one-way street.
So you trade future flexibility for a big upfront deduction.
Exactly. It's a strategic choice. For example, if you buy a qualifying heavy SUV for $60,000 and use it 100% for business, you could potentially deduct $30,500 via Section 179 in year one, plus maybe some regular depreciation on the rest. That's a huge immediate tax saving, giving you capital back quickly rather than spreading the deduction over 5 or 6 years. It's a powerful incentive to invest in qualifying business assets.
Beyond Section 179, you mentioned regular depreciation limits. What are those?
Yes, even if you use your cart 100 for business and use the actual expense method, there are annual limits on the amount of regular depreciation in Section 179 for lighter vehicles you can claim each year. These are often called the luxury auto limits, even though they affect cars that aren't necessarily luxury models. These limits cap the depreciation deduction each year. For a car placed in service in 2024 where bonus depreciation is claimed, the first-year limit is $20,400. If bonus isn't claimed, it's $12,400. The limits decrease in subsequent years.
What happens if the car isn't fully depreciated by the end of the normal period because of these limits?
Good question. If your car has an unrecovered basis at the end of its normal recovery period, usually 5 years for cars, due to these annual limits, meaning you still have remaining cost basis that hasn't been fully deducted, you can continue to claim depreciation deductions in later years. For instance, for a car that finished its normal 5-year recovery period but still has basis left, you could potentially claim up to $7,360 for 2024 indexed amount in depreciation each subsequent year until that basis is fully exhausted. This extends your tax benefits beyond the typical depreciation time frame.
Okay, one more thing under actual expenses.
Yeah.
What happens if my business use changes? Like if I start using the car more for personal trips?
That's a critical point and a common pitfall. You need to be very careful about maintaining your level of business use, especially if you claim Section 179 or bonus depreciation. If your business use of the car drops to 50% or less in any year after the first year it was placed in service.
50% or less?
Yes. If that happens, you may have to recapture some of the depreciation you previously claimed. This essentially means adding back a portion of your prior deductions to your income in the year the usage drops. It can be a nasty surprise. Additionally, if business use drops to 50% or less, you must switch to using the straight-line method of depreciation for that vehicle for all future years, which generally results in smaller annual deductions than accelerated methods. This is why consistent tracking of business versus personal mileage year after year is absolutely vital when using the actual expense method.
Okay. Any exceptions to these tricky depreciation and usage rules?
Yes, there's a category called qualified non-personal use vehicles. These are vehicles that, by their very design, aren't likely to be used more than a minimal amount for personal purposes. Think ambulances, hearses, specially modified delivery trucks with permanent shelving and maybe painted company logos, bucket trucks, cement mixers, etc.
Vehicles clearly built for work.
Exactly. These types of specialized vehicles are generally exempt from the Loesch auto depreciation limits and the strict record-keeping rules required to prove business versus personal use. Their deductions are usually much more straightforward under the actual expense method.
So with all these incredibly detailed options and rules,
Yeah.
what does this all mean? How does a listener actually choose between the standard mileage rate and actual expenses to get the best tax savings for their specific situation? This seems like the core decision for many people driving for business.
It really is the core decision, and there's no single answer that fits everyone. The best choice depends entirely on your specific circumstances, your vehicle, your driving patterns, and frankly, your tolerance for record keeping. It's a decision worth evaluating carefully, especially in the first year, and then potentially annually if you own the car. Here's a general guideline. If you drive a very high number of business miles each year, the standard mileage rate often comes out ahead or is very competitive, plus it's simpler. However, if you've purchased a new, relatively expensive car, especially one with substantial depreciation potential, like those heavier SUVs qualifying for the higher Section 179 limit, and you have high actual operating costs, maybe high gas prices, lots of repairs, high insurance, then the actual expenses method might yield a significantly larger total deduction, especially in the early years. It's definitely worth running the numbers in that scenario.
So high mileage might favor standard rate, high costs might favor actual expenses.
That's a reasonable starting point, yes. Also consider the vehicle's age. For older cars where depreciation is minimal or finished, the standard mileage rate might become more attractive again compared to just tracking gas and minor repairs. The simplicity of the standard mileage rate itself can be a form of tax savings, as it dramatically reduces your record-keeping burden compared to tracking every single receipt for gas, oil, repairs, etc. Time is money, after all. The ultimate tax savings really come from making an informed choice. Run the calculations both ways, especially in the first year you place a car in service for business. Project your mileage, estimate your actual costs, including depreciation. See which method gives you the better result. Remember, for owned cars, if you start with standard rate, you can reevaluate this choice each year. For leased cars, that initial choice is binding if you pick the standard rate. Making that strategic decision thoughtfully can put significantly more money back in your pocket at tax time.
Okay, we've covered a ton of ground on what you can deduct: travel, meals, gifts, car expenses. But this next part might not be the most glamorous aspect of tax planning, yet it's arguably the absolute most important. Because without proper records, all those potential deductions we've just spent time detailing might as well be invisible to the IRS, right?
You are absolutely right. This cannot be stressed enough. It's the foundation upon which all these deductions rest. If you deduct travel, gift, or transportation expenses, you must be able to prove, the IRS calls it substantiate, certain specific elements of each and every expense. You simply cannot deduct amounts that you approximate or estimate based on guesswork. The IRS is very clear and very strict on this. Meticulous record keeping is the undisputed golden rule for realizing any of the tax savings we've discussed. It's the critical difference between a legitimate, allowed deduction and one that gets thrown out on audit.
So, okay, substantiation. What exactly do I need to prove for each expense to make it legitimate in the eyes of the IRS? What are the key elements I absolutely need to capture in my records?
You need to keep records showing the following 5 critical elements for basically every business expense, especially travel, meals, gifts, and transportation. First, the amount. What was the exact cost of each separate expense? For example, the cost of the plane ticket, the hotel bill, the meal receipt. For efficiency, small incidental expenses like taxi fares or tips throughout a day can often be totaled in reasonable categories. Second, the time. This involves the specific dates. Dates you left and returned for trips. The number of days spent on business versus personal activities. The exact date a gift was given. The date of business car use. Third, the place or description. Where did the expense occur? For travel, the destination city or town. For gifts, a clear description of the gift itself. For transportation, your specific business destination or the route taken for business. Fourth, the business purpose. This is arguably the most crucial element, the why. Why was this expense necessary for your business? What business benefit was gained or expected to be gained from this expenditure? This justifies the deduction. Be specific. Client meeting to discuss Project X is better than just client meeting. And fifth, the business relationship. This element applies specifically to deductions for gifts and certain business meals or entertainment where deductible. Who was the recipient of the gift or who attended the meal? What was your specific business connection or relationship to them? This proves the legitimacy of the business interaction.
Okay, amount, time, place, business purpose, and business relationship. Got it. Now, what actually qualifies as adequate records in today's digital world? Do I still need a physical diary and that classic shoebox overflowing with crumpled receipts, or can I use modern tools like a digital app? And what makes a receipt itself adequate?
That's a great question, and the IRS is actually quite flexible here, embracing technology. An account book, a traditional physical diary, a log book, a detailed statement of expense, trip sheets, these all still work. But crucially, similar written or computer records are also considered adequate. So yes, a digital log maintained on your computer or a dedicated mileage and expense tracking app on your smartphone can absolutely satisfy the requirement for recording the elements of the expense. Many people find these digital tools far more efficient and accurate.
So the log is key. What about truth, like receipts?
Beyond the log where you record the elements, you generally also need to keep documentary evidence for many expenses. This typically means actual receipts, paid bills, or canceled checks, though checks alone often aren't enough. These documents provide third-party verification of the expense amount and date, adding significant credibility to your log.
Do I need receipts for everything, even a $2 coffee?
Thankfully, no. There are a few key exceptions where documentary evidence, like a receipt, is generally not required, which can significantly simplify things. This is a nice practical tax-saving tip in terms of time. You generally don't need receipts for expenses related to meals or lodging if you are accounting for them to your employer under an accountable plan using a standard per diem allowance, as long as the allowance is at or below the federal rates. Your employer's plan handles the substantiation there. Also, critically, you generally don't need receipts for any single expense. Other than lodging, you always need lodging receipts, if that expense is less than $75.
Less than $75, no receipt needed. That's huge.
It is very helpful. It covers many smaller meals, taxi rides, supplies, etc. Just remember, even if you don't need the receipt because it's under $75, you still need to record the amount, time, place, and business purpose in your timely log. The log entry is still required. And finally, you might not need a receipt for certain transportation expenses where a receipt isn't readily available, like maybe some cash-only toll booths or old-style parking meters.
Okay, under $75 helps a lot. But for lodging and expenses over $75, what makes a receipt adequate? What info needs to be on it?
Good question. The receipt needs enough detail to support your log entry. For a hotel receipt, it should clearly show the hotel's name and location, the specific dates of your stay, and preferably separate amounts charged for lodging versus meals, telephone calls, or other services. Itemization is best. For a restaurant receipt to prove a meal expense over $75, it needs the name and location of the restaurant, the number of people served, if relevant for substantiating a business meal with others, the date, and of course the amount paid. And remember, a canceled check by itself usually isn't enough proof. It shows you paid someone, but not necessarily what you paid for. It ideally needs to be accompanied by other evidence, like a corresponding bill or invoice, to prove the specific business nature and elements of the expense. Clarity and sufficient detail are key.
You mentioned timely kept records. How timely is timely? Do I need to log things the second I spend the money?
The timing of your record keeping is also vital. The IRS regulations stress the need for timely kept records. This means you should record the elements of an expense or business use in your log at or near the time the expense or use occurs.
At or near the time, so not weeks later.
Preferably not. Recording it while the details are still fresh in your mind leads to more accurate and credible records. Recording expenses weekly, for example, for ongoing things like car use, is explicitly mentioned by the IRS as generally being considered timely. Waiting until month-end, or worse, year-end, to try and reconstruct everything is risky and makes your records less reliable.
Okay, keep the log updated regularly. What if, despite best efforts, my records aren't absolutely perfect? Maybe I lost a receipt over $75, or my log is missing a detail. Is there any leeway, or am I just entirely out of luck for that deduction?
If you have incomplete records, you're not entirely out of luck automatically, but you will certainly have a higher burden of proof. The rules allow for substantiation by other means in some cases. You must attempt to prove the missing elements with your own detailed written or oral statement containing specific information about the expense, plus other corroborating supporting evidence.
Other supporting evidence, like what?
If the missing element is the cost, time, place, or date of an expense, the supporting evidence ideally needs to be direct evidence, like testimony from a client you dined with confirming the meal and discussion, or other documentary evidence, like maybe a credit card statement showing the charge, even if you lost the itemized receipt. If the missing element is the business relationship or the business purpose, then circumstantial evidence can sometimes suffice. This could include things like the nature of your work, for example, a delivery driver's route sheet supporting car use, your appointment calendar showing a client meeting, or maybe correspondence related to the business purpose. The IRS might allow for reasonable reconstruction if you can provide strong, credible corroborating evidence, but it's definitely not guaranteed. Having complete, timely records is always the best defense.
Okay. Is there any way to simplify record keeping, especially for something continuous like car use? Tracking every single trip seems daunting.
Yes, here's a very helpful tip, especially for car use, that can significantly simplify your life without necessarily sacrificing your deductions. You might be able to use a sampling method.
Sampling, how does that work?
If you keep adequate, detailed records for representative periods, for instance, maybe you meticulously track all business versus personal mileage for the first week of each month, and you can demonstrate through other evidence, like appointment logs, sales reports, that your business use during those sample periods was truly typical of your use throughout the entire year. Then those detailed sample period records can potentially be sufficient evidence to prove your total business use percentage for the entire year.
So detailed tracking for a week each month could support the whole year's percentage.
Potentially, yes, if you can show it's representative. For example, if your detailed weekly logs for the first week of each month consistently show 75% business use of your car, and you can also show continued, consistent business activity throughout the year with invoices, client logs, or delivery records, the sampling method can often support claiming that 75% business use for the entire year's mileage. This significantly simplifies the ongoing daily record-keeping burden without losing the deduction, a powerful time saver.
That's a great practical tip. One last thing on records.
Yeah.
How do I handle multiple expenses on a single outing? Like, say, a business dinner followed immediately by taking the client to a show, even though the show is not deductible. Do I combine them in my log, or must they be separate entries?
Generally, each separate payment you make should be treated as a separate expense in your records. This is important for applying the correct rules. So, in your example, a business dinner followed by theater tickets for a client. The dinner expense and the cost of the theater tickets are two distinct expenses. You must record them separately in your log.
Why separate if the tickets aren't deductible anyway?
Because different rules and limits apply. The dinner might be 50% deductible if costs were separate from any entertainment package, while the theater tickets are 0% deductible entertainment. Lumping them together would obscure this and could jeopardize the meal deduction. Clarity is essential. However, for efficiency, you can often make one single daily entry in your log for reasonable categories of small, similar expenses. For instance, you could have one entry for taxi fares, $35, covering multiple trips that day, or business phone calls, $15. Just be sure non-entertainment meals are always kept in their own separate category due to the potential 50% limit. For car expenses, a single log entry can usually cover a continuous round trip or an uninterrupted period of business use, like multiple deliveries made along a single route before returning. And for gifts, a general listing is usually acceptable as long as it's clear you're accurately tracking the recipients and staying within the $25 limit per person, not trying to obscure multiple gifts to the same individual. The overall goal is clarity, accuracy, and adherence to the specific rules for each type of expense, which ultimately protects your hard-earned deductions.
All right, this has been incredibly detailed. We've tracked everything meticulously according to the golden rule. Now, for the final, absolutely crucial step for realizing those tax savings, how do you actually report these expenses on your tax forms? And critically, what happens if your employer reimburses you for some or all of these costs? This feels like where the rubber truly meets the road for the tax filing itself.
This is indeed a critical distinction, and understanding it can make a significant difference in your final taxable income and the complexity of your tax return. It all hinges on whether your employer's reimbursement arrangement qualifies as an accountable plan or a non-accountable plan. This classification determines everything about how the reimbursement is treated for tax purposes.
Accountable versus not accountable. Okay, let's break down accountable plans first. What makes a plan accountable?
An accountable plan is an employer's reimbursement or expense allowance arrangement that meets three specific requirements set by the IRS. If all three are met, it's generally very favorable for the employee. Requirement 1. The expenses must have a business connection. They must be allowable deductible expenses incurred while performing services as an employee. Requirement 2. You, the employee, must adequately account for these expenses to your employer. This generally means providing the same kind of proof we just discussed, logs, receipts where required, showing amount, time, place, and business purpose.
Account for them. How quickly?
That's requirement 3. You must adequately account within a reasonable period of time. The IRS generally considers actions taken within certain time frames as reasonable. For example, substantiating expenses within 60 days after they were paid or incurred is usually considered reasonable. Receiving a travel advance within 30 days of the trip, accounting within 60 days after, and returning any excess within 120 days after the expense is also a safe harbor. And that leads to the other part of requirement 3. You must be required to return any excess reimbursement or allowance, any amount paid to you that exceeds the expenses you actually incurred and adequately accounted for within a reasonable period of time.
So no keeping the extra cash if you underspend in advance.
Exactly. If you receive a $500 travel advance but only spend and account for $400, you must return the remaining $100 to the employer under an accountable plan. If you don't have to return it, or if any of the other requirements aren't met, the entire plan might be classified as non-accountable.
Okay, business connection, adequate accounting, return of excess. If a plan meets all three, what's the big benefit for the employee? Why is this the favorable option?
The big benefit is a significant tax saving and simplification for you, the employer. Reimbursements received under a qualifying accountable plan are not included in your gross income. They are not reported as wages in Box 1 of your Form W-2.
Not income at all.
Correct. They are generally treated as repayment, not taxable income to you. This is a huge advantage. You avoid reporting income that you would then potentially have to figure out how to deduct, which, as we'll see, is now very difficult for most employees. It simplifies your tax return and reduces your taxable income right off the bat.
That's fantastic. But what if my actual expenses are more than the reimbursement I receive under an accountable plan? Say, my actual hotel and meal costs end up being higher than the per diem allowance my employer paid me. Can I deduct the difference?
That's a great question. If your actual substantiated business expenses are more than what you were reimbursed under an accountable plan, you may be able to deduct that excess amount. However, and this is a huge however, due to recent tax law changes, you must be in one of the very limited categories of employees who can still claim unreimbursed employee business expenses. If you are eligible, you typically report the full expense and the reimbursement on Form 2106, Employee Business Expenses, and the net deductible amount would flow to Schedule A as an itemized deduction, or potentially an adjustment to income for Armed Forces Reservists, etc. But again, you must be prepared to prove the total expenses to the IRS, not just the excess amount you weren't reimbursed for.
Okay, so possible, but only for certain employees now. You mentioned per diems. Are per diem and car allowances typically part of accountable plans?
Yes, they are very common forms of reimbursement used within accountable plans, especially for travel and vehicle costs. A per diem is a flat daily amount the employer provides for lodging, meals, and incidental expenses, M&IE, when you're traveling away from home. A car allowance is an amount given for the business use of your personal vehicle, often paid as a cents per mile rate or a flat monthly amount. These allowances can simplify things because they can satisfy the adequate accounting requirement for the amount of your expenses if the allowance rate paid by the employer is equal to or less than the standard federal rates.
The federal rates, like the M&IE rates and standard mileage rate we discussed?
Exactly. If your employer reimburses you using a per diem or mileage allowance at or below the published federal rates, the IRS considers the amount of your expense to be substantiated. You still need to substantiate the time, place, and business purpose of the travel or mileage to your employer, but you don't need to give them receipts for the actual amount spent on meals or car operation, though you still need lodging receipts if the per diem only covers M&IE.
Can you remind us of those key federal rates for context?
Sure. The federal per diem rates for lodging, meals, and incidentals vary significantly by location and time of year. You find them on gsa.gov. For instance, a high-cost city might have a combined lodging and M&IE rate over $300 per day, while standard areas are lower. The M&IE portion alone also varies maybe $64 or $86 per day depending on location and date in 2024. And the federal standard mileage rate for business use of a car in 2024 is 67 cents per mile. If your employer's allowance meets or is less than these rates and you account for the trip details, the reimbursement under an accountable plan is generally non-taxable to you. That's a direct tax saving and simplifies reporting immensely.
Okay, accountable plans sound great for employees. Now let's talk about the flip side, non-accountable plans. What makes a plan non-accountable and what are the consequences? These sound like the ones you want to avoid.
They generally are less favorable from an employee tax perspective, yes. A reimbursement or allowance arrangement is treated as a non-accountable plan if it fails any one of the three tests for an accountable plan: business connection, adequate accounting, return of excess. For example, if your employer gives you a monthly travel stipend but doesn't require you to prove how you spent it or doesn't require you to return any unused amount. Or, critically, if your employer arranges to pay you a specific amount for expenses by simply reducing your regular salary or wages to cover those anticipated expenses, that's automatically not accountable because you would get your full salary regardless of whether you incurred the expense.
Okay, so if the plan is non-accountable, what's the consequence for the employee's taxes?
The consequence is significant and generally negative. Any reimbursement or allowance you receive under a non-accountable plan is included in your taxable income. It must be reported as wages in Box 1 of your Form W-2, just like your regular salary.
So you pay income tax, Social Security, Medicare tax on that reimbursement money.
Yes, it's treated exactly like regular wages.
Ouch. Can you then deduct the actual business expenses you incurred?
Here's the second major blow, especially after the recent tax law changes. If you are reimbursed under a non-accountable plan, meaning the reimbursement is already included in your W-2 income, you can only deduct your related business expenses for travel, transportation, meals, subject to 50% limit, etc., if you are one of those very few eligible employees we mentioned earlier who can still claim miscellaneous itemized deductions or specific adjustments. For the vast majority of typical W-2 employees, these unreimbursed expenses, even though technically reimbursed via taxable wages, are no longer deductible on their federal return due to the suspension of miscellaneous itemized deductions subject to the 2% AGI floor.
So under a non-accountable plan, most employees get taxed on the reimbursement and get no deduction for the expense. That's a double whammy.
It effectively is for most employees now. It really underscores the immense value of having your employer use a properly structured accountable plan. It saves the employee taxes and simplifies their filing significantly.
This is incredibly important. Now, the final piece. Where do you actually report these expenses and reimbursements on the tax forms? You mentioned Schedule C, Form 2106. Let's clarify this, especially considering those big changes for employees. This is crucial for the listener doing their taxes.
Absolutely. Knowing where to report or not report is key, and it differs significantly based on whether you're self-employed or an employee and which type of employee. Let's start with self-employed individuals. If you operate your business as a sole proprietor, a single-member LLC filing as a sole proprietor, a partner in a partnership, or an independent contractor receiving a Form 1099 NEC or 1099 MISC, you do not use Form 2106 for your business expenses. Form 2106 is strictly for employee business expenses.
Okay, no Form 2106 for the self-employed. Where do their expenses go?
Your deductible business expenses for travel, meals, subject to the 50% limit or exceptions, gifts, subject to the $25 limit, car and truck expenses, using either standard mileage or actual costs, and other ordinary and necessary business expenses are reported directly on Schedule C, Form 1040, profit or loss from business. If you're a farmer, you'd use Schedule F, Form 1040, profit or loss from farming. If the expenses relate specifically to rental property income, they generally go on Schedule E, Form 1040, supplemental income and loss.
And these are direct deductions against business income.
Yes, for self-employed individuals, these are generally direct deductions against your gross business income reported on these schedules. This reduces your net profit subject to both income tax and, importantly, self-employment tax, Social Security, and Medicare. This is a fantastic tax benefit, making diligent tracking and claiming of all legitimate expenses absolutely critical for the self-employed.
Okay, that's clear for the self-employed. Schedule C, F, or E. Now, for employees, this is where you said the big changes happen. How do W-2 employees report these now?
This is where the landscape shifted dramatically after the Tax Cuts and Jobs Act of 2017 suspended most miscellaneous itemized deductions. For tax years 2018 through 2025, the bottom line is most employees can no longer use Form 2106 to deduct their unreimbursed employee business expenses on their federal tax return.
Most employees just can't deduct these anymore, even if they have legitimate expenses their employer didn't cover under an accountable plan.
That's generally the tough reality for federal income tax purposes during these years. If your employer doesn't reimburse you under an accountable plan, meaning any reimbursement is taxed as wages or you receive no reimbursement at all, those common employee business expenses like unreimbursed travel, meals, home office use for convenience of employer, tools, supplies, professional dues are generally not deductible for most W-2 employees. It highlights the critical importance of understanding your employer's reimbursement policies and perhaps negotiating for an accountable plan if possible.
Wow. So who can still use Form 2106? Is anyone left?
Yes, the use of Form 2106 is now primarily limited to a very specific, narrow set of employees defined in the law. 1. Armed Forces reservists who travel more than 100 miles from home for their reserve duties. 2. Qualified performing artists meeting specific income and expense criteria. 3. Fee-basis state or local government officials. Individuals compensated solely on a fee basis for performing personal services as a public official. 4. And employees with impairment-related work expenses, expenses for attendant care or other workplace needs necessary for the employee to work due to a physical or mental disability.
So a very short list.
Yeah.
Anyone else?
There's one other less common situation. If you are an employee and your employer provides you with a company car, but includes 100% of the value of that car's personal use in your W-2 income, you can potentially use Form 2106 to deduct the business use portion of the actual expenses related to that car. But that's a specific scenario involving employer-provided vehicles.
Okay. So for those few who are eligible to use Form 2106, how does it work?
If you fall into one of those eligible categories, you would use Form 2106 to calculate your deductible expenses. You report your total business expenses, like transportation using standard mileage or actual costs, travel expenses like lodging and 50% of meals on specific lines. Then you report any reimbursements you receive from your employer for those expenses that were not included in Box 1 of your W-2, i.e. reimbursements paid under an accountable plan, often reported with Code L in Box 12 of the W-2. The form then calculates the net amount of unreimbursed expenses. This amount generally carries to Schedule 1, Form 1040, as an adjustment to income for reservists, performing artists, and fee-basis officials, or to Schedule A, Form 1040, as an itemized deduction for impairment-related work expenses. The form also has lines to handle allocation if your employer gave you a single reimbursement amount covering different types of expenses, like meals and lodging, without specifying how much was for each. You'd need to prorate the reimbursement based on your actual expenses to apply limits correctly. It requires careful calculation.
So let me just summarize this critical point for listeners. For the vast majority of regular W-2 employees, if their employer doesn't reimburse them for business expenses under a qualifying accountable plan, those unreimbursed expenses, travel, meals, car use, home office supplies, are effectively non-deductible on their federal tax return right now.
That's generally the correct understanding for federal income tax purposes for tax years 2018 through 2025. Some states may still allow these deductions on the state tax return, but federally, the deduction is suspended for most employees. It makes those accountable plan reimbursements even more valuable, as it's often the only way for employees to get tax-free recovery of their business expenses. Hashtag tag tag outro.
Wow, what an incredibly detailed and, frankly, eye-opening deep dive into the world of business expenses. We've really unpacked everything from the foundational concept of your tax home to the complex rules for international travel, the tricky nuances of business meals and that 50% limit, the surprisingly strict $25 gift rule, and the absolutely crucial choices involved in car expenses.
The biggest takeaway here for you, the listener, really has to be that knowledge truly is power when it comes to navigating the tax code effectively. Understanding these detailed rules, what's deductible, what's not, the specific limits, the reporting requirements, can lead to significant real dollar tax savings. Or, just as importantly, help you avoid common pitfalls that could cost you money or attract unwanted IRS attention.
And it feels like almost every single deduction we discussed hinges on one simple yet often overlooked golden rule that underpins everything. Record keeping is king. If you don't have those meticulous contemporaneous records proving the amount, time, place, business purpose and sometimes the business relationship,
Yeah,
well, those deductions are just wishful thinking on a tax form.
exactly. Without solid documentation, even the most legitimate, ordinary, and necessary business expense can be disallowed upon examination. That detailed record keeping isn't just bureaucracy, it's the essential proof that validates your claims. It's the foundation of strategic tax planning.
This really raises an important question for you, the listener, to think about. How can you proactively integrate careful, consistent record keeping into your daily or weekly business routines, making it a habit rather than a dreaded year-end scramble trying to reconstruct everything?
And maybe consider how understanding these specific rules might influence your future choices. Knowing the 80% meal deduction for DOT workers, or the $25 gift limit, or the benefit of separate itemization for meals at entertainment events, how might that knowledge change how you approach business travel, client appreciation, or even vehicle use moving forward to strategically maximize those valuable deductions right from the start?
Absolutely. Whether you're an employee trying to understand reimbursements and navigate the current limitations, a self-employed individual aiming to maximize deductions on your Schedule C, or a small business owner looking for strategic write-offs and efficient reporting, this information should empower you to approach your tax situation with far more confidence and clarity. And remember, for more detailed guidance tailored to your specific situation, always consult the official IRS resources we mentioned, like Publication 463, Travel, Gift, and Car Expenses, which is available free online at irs.gov. Or consider seeking assistance from a qualified tax professional or utilizing free tax help programs like Vito if you qualify. That's it for this deep dive. Join us next time for more insights to help you stay well-informed and ahead of the curve.